Welcome to this explainer. Today, we're literally cracking open the hidden institutional toolbox to reveal the invisible alpha hiding in plain sight. We're talking about strategies that don't try to predict the future, because honestly, who can do that reliably? Instead, we're looking at how the big players exploit the exact structural mechanics of the present.
So where do institutions actually find alpha when the markets just go sideways? To answer that, we're pulling right from chapters 13 and 14 of 151 Trading Strategies. We'll see how elite quant desks systematically exploit man-made rules, macroeconomic metrics, and even literal physical realities like the weather. It's fascinating stuff.
Here's our quick roadmap. We'll start with the hidden institutional toolbox, then move into exploiting tax asymmetries, the options tax loophole, hedging and arbitraging inflation, trading physical realities, and finally, how one mathematical scaffolding ties it all together. Let's get right to it.
All right, part 1, exploiting tax asymmetries or finding the wedge in man-made rules. We're going to kick things off with strategy 1, which is municipal bond tax arbitrage. This one exploits a purely structural inefficiency.
Take a look at this equation right here. It represents a massive institutional advantage. The idea is simple but powerful. Borrowing money to buy tax-exempt municipal bonds. That big R is your strategy return, which equals the tax-exempt muni interest rate, that's R sub long, minus the cost of your short loan, R sub short, multiplied by 1 minus tau, the corporate tax rate.
Now, when you lay out the variables like this, it clicks, right? You see exactly why this specific wedge only works for corporate entities sitting in tax-field jurisdictions. Think about it. If you can legally deduct your interest expenses from your taxable income, that loan rate effectively shrinks. You're basically borrowing at a subsidized rate just to buy a tax-free yield. It's a pure, structural wedge hiding in plain sight.
Moving on to strategy 2, cross-border tax arbitrage. This is where we see a stark wedge between domestic and foreign investors in countries that use dividend imputation systems, places like Australia or Singapore. See, domestic investors get a sweet tax credit attached to their dividends to avoid double taxation, but foreign investors, they usually get left out in the cold. Because of this, the standard price drop when a stock goes ex-dividend is actually larger than the cash dividend itself. The market is literally pricing in that domestic tax credit. So if you're a foreign investor holding through the dividend date, you are mathematically penalized, no way around it. Which brings us to the options tax loophole, pricing the dividend tax credit. Since foreign investors want to avoid that penalty, they'll either sell the stock come dividend and buy it back ex-dividend, or they get crafty and use options to exploit it. This is strategy 3.
Here's the trick. By writing a deep in-the-money put option that's mispriced relative to the tax credit adjusted dividend, an institution can totally legally harvest that tax credit rate. How? Well, if a deep in-the-money put isn't fully pricing in the extra price drop from the domestic tax credit, a quant desk can sell the physical stock come dividend at its current price, while simultaneously writing this put option. And the result? The final P&L when the option is exercised ex-dividend perfectly captures that invisible credit as pure arbitrage profit. In this formula, that kappa is the tax credit rate. It's wild, right? The foreign institution never actually collected the tax credit from the government. Instead, they extracted it directly from options market mispricing.
Okay, next section. Hedging and arbitraging inflation, capitalizing on macroeconomic metrics. We are officially leaving man-made tax rules behind and popping the hood on how big players trade inflation metrics via swaps and tips.
Strategy 4 centers on this precise definition of the zero coupon inflation swap. Here, smart money buys if expected inflation exceeds the break-even rate, K, exploiting the floating CPI index. You're basically swapping a fixed expectation for the actual floating reality of inflation. It is a highly direct, surgical bet without ever having to touch physical commodities or mess with traditional bonds.
And that leads right into strategy 5, treasury arbitrage. Institutions use those exact 2 steps to build a synthetic treasury. Why? Because physical treasuries empirically tend to be overvalued. So, step 1, you buy match maturity TIPS, treasury inflation-protected securities. Step 2, you sell zero coupon inflation swaps to strip out all that inflation variability, converting it to fixed payments. Boom. You've just built a synthetic treasury bond with the exact same risk profile and cash flows as the real deal.
The empirical truth of this wedge is all right here in the net cash flow. The physical treasury price minus the synthetic replication you just built is mathematically greater than 0.
So you short the expensive physical treasury, you buy your cheaper synthetic version, and you just pocket the difference on day zero. It's a literal arbitrage that, according to textbooks, shouldn't exist in a perfectly efficient market. And yet, historically, it persistently does.
Moving on to trading physical realities, quantifying the physical world. We're shifting from macroeconomics to strategy 6, where the same hardcore quantitative rigor gets applied to the actual weather and energy conversion. Basically, if you can quantify it, you can trade it.
Now look at cooling degree days and heating degree days. These aren't just abstract variables on a chalkboard. They represent actual summer heat waves and winter freezes, all measured against a flat 65-degree Fahrenheit baseline. This is used to perfectly hedge corporate demand risk. Say a utility company knows they bleed money on mild winter days. They can construct a synthetic index based on heating degree days. Every single degree the daily temperature falls below 65 counts as a quantifiable unit of demand.
And this definition here is what allows quant desks to mathematically calibrate the exact ratio of weather futures contracts they need to cover their specific physical variance. By measuring the covariance between their actual physical output, say energy sales or even crop yields, and the weather index, then dividing that by the variance of the index itself, they can literally hedge against the chaotic nature of the physical environment. Pretty incredible.
Our final deep dive today is strategy 7, the energy spark spread. This isolates the very specific physical wedge of fuel conversion. Simply put, it looks at the difference between the price of electricity leaving a power plant and the price of the fuel needed to generate it. Let's translate these variables into the real world. That H right there, it represents the actual thermodynamic efficiency of a power plant turning natural gas into electricity. The spark spread isn't just some arbitrary market price difference. It is strictly governed by the unyielding laws of thermodynamics. If the spread ever widens beyond the physical cost of firing up that plant, a trader can essentially step in and rent the power plant's efficiency for profit.
And this final equation perfectly aligns that thermodynamic heat rate with the physical contract sizes of power and fuel on the futures exchange. See, you can't just log on and buy 1 unit of power and 1 unit of gas. You have to map that physical efficiency H to the rigid contract sizes enforced by the exchanges, like 736 megawatt hours for power or 10,000 MMBTU for gas. When you balance that correctly, you are isolating pure fuel conversion profit.
Finally, one mathematical scaffolding, or the invisible alpha connecting it all. Whether we are trading obscure tax codes, inflation metrics, or a power plant's heat rate, we arrive at the exact same conclusion. The underlying quantitative scaffolding is identical.
Think about what we just covered. We successfully deconstructed 7 wildly different institutional strategies, unifying them into a kind of masterclass on finding and exploiting hidden market wedges. From utilizing tax shield jurisdictions to synthesizing treasuries out of tips, right down to mathematical formulas bounding option prices to snag foreign dividend credits. None of this is guesswork. It is the calculated, systematic extraction of value.
If you take away anything from this explainer, make it this core truth. It's the exact philosophy driving all elite proprietary trading desks, totally regardless of the asset class. Arbitrage is simply finding the mathematical wedge between 2 related assets and exploiting it. It doesn't matter if those assets are linked by an imputation tax law in Singapore, the CPI index in Washington, or the literal thermodynamic conversion of gas into electricity. Once you find the formula linking them, you just sit back and wait for the market to misprice them.
So now that you're armed with this institutional playbook of invisible alpha, the only question left is, where are you going to look for your next wedge? If quant desks can find an edge in something as mundane as the daily temperature relative to 65 degrees, what inefficiencies are hiding right now in the assets you already trade? Keep looking under the hood, keep quantifying those relationships. Thanks for joining me, and I'll catch you in the next explainer.